All right, this is just a short video on what to do when there are conflicting themes underlying a given investment you're either invested in already or thinking of making. And so one is bullish and one is bearish. And I'll just give a good example here that's happening right now, and that's the banking sector. If you think about it, right now in terms of the cyclical environment or the economic backdrop, it's quite bullish for the banking sector because we're having a recovery, COVID is ebbing, the housing market is very, very strong, and the interest rate environment is extremely bullish for banks. Basically, the difference between short and long rates is spreading, opening up, and the yield curve just is a better environment for banks to make money by borrowing at lower rates and lending at higher rates. So this is an environment where bank stocks do well, and the banking sector is going to be making better and better results, producing better and better results in the quarters to come. Okay, so that's the bullish case. But there's actually sort of an existential threat that the banking sector is facing, and that comes from the world of cryptocurrency. So the idea of cryptocurrency is that layers are being built on top of your basic crypto, blockchain technology that is going to disintermediate the banking sector. They will have various technologies that are emerging right now that will basically digitize and produce an existential threat to existing modern banking. And so the way to think about it is that crypto will do to the banking sector what digital photography did to Kodak. And it took a while, but it was one of those gradually but suddenly kind of situations that it didn't seem like much was happening. And then all of a sudden, Kodak went bankrupt. And so this is sort of a longer term but very existential threat for the banking sector. Okay, so these two ideas are definitely in conflict. What do you do if you're already invested in banking stocks? For example, I have some bank stocks in my portfolio. And what I'm probably going to do is what I always do in cases when there's different types of doubt and we don't know. And that means what I'll be doing is making small incremental steps. In the coming months and quarters, I'll be trimming back my bank exposure, but doing so gradually. If the sector starts to do very, very well, which it has been so far, but it may do better because the banking sector's relatively undervalued compared to the rest of the stock market, I'll probably trim more into strength. If there's a major sell-off, I'll probably sit tight and wait. But in the interim, I'm just going to be making some small trims over the coming months and quarters. Now, if you're not yet invested in the banking sector, I think these two themes kind of net out as sort of a net zero reason to invest. I don't think I would be putting new money into the banking sector right now if I didn't have already some investments. And if you already are invested in this sector, I don't think you need to liquidate everything right away. This is sort of one of these epistemically arrogant decisions where you're deciding too aggressively and too rapidly. It's one of these things where take some gradual steps and peel off exposure over the coming months or even couple of years. But this is not a sector to be adding to because of this greater long-term existential risk. So here's just a good example of where there's a lot of doubt in the stock market. It's hard to know how it's going to play out, but you can make incremental steps or avoid a sector just to stay out of the way. And so this is how I would grapple with it. All right, thanks for watching.